All right, let's jump right into this explainer. Today we're tackling something absolutely crucial: how to simultaneously manage inventory risk while preserving your queue priority in high-frequency market making. If you've ever built a trading algorithm, you already know the struggle. Keeping your position near zero without bleeding out on spread costs is, frankly, one of the hardest balancing acts in quantitative finance. But what if a single, continuous mathematical curve could actually solve it? Well, we're unpacking a really fascinating piece of research today that introduces a highly flexible, continuous math approach to do exactly that.
So here's our playbook for the explainer. We'll quickly run through 1. The market maker's dilemma, 2. Introducing scaled beta policies, 3. Optimizing order volume profiles, 4. Preserving your queue priority, 5. Smart inventory management strategies, and finally, 6. The bottom line. Let's get right to it.
Section 1. The market maker's dilemma. Let's start with the twin villains that are probably destroying your algorithmic P&L right now: inventory risk and lost queue priority.
As a market maker, your absolute biggest fear is having to constantly cancel orders just to adjust a spread, right? Because most major exchanges operate on a really strict price-time priority system. If you want to shift your quoted price using a traditional single price level strategy, you're forced to cancel your current order, submit a new one, and basically go straight to the back of the line. You forfeit all that hard-earned queue position, which means your actual orders are just sitting there, completely unfilled.
And when your orders aren't getting filled quickly, you face the ultimate nightmare: adverse selection. This usually happens when the market shifts rapidly, counterparties exploit a speed or informational advantage, and you're just forced to react. Before you even know what hits you, you're left holding a massive, directional inventory right as the market violently moves against you. You're literally left holding the bag.
Section 2. Introducing scaled beta policies. To beat these challenges, we really need a mathematical hero that bridges the gap between legacy, rigid strategies and infinite flexibility. Enter the scaled beta policy.
Think about standard ladder strategies for a second. They place uniform volume across a set block of prices. They're clunky, they're rigid. But scaled beta distributions, they're a game changer. They allow you to flexibly skew your order volume across different price intervals. The beta distribution naturally curves the volume. You can heavily weight your orders right up close to the touch, or gently push them further out into the book. And it's all cleanly defined by one continuous curve.
Section 3. Optimizing order volume profiles. So the really crucial point here is understanding how to actually translate this continuous mathematical concept into live, discrete order book data.
Because obviously you can't just send a continuous curve to an exchange. Here is the functional execution phase. Step 1 is quantitization. You evaluate that beta function at specific price levels, normalize it to 1, scale it by the total volume you want to deploy, and then just round it to the nearest integer. Step 2 is conversion. You basically calculate the difference against your active internal book to generate live orders. If the math says you need more volume at a specific level, you send a new limit order. If it dictates less, you simply send a cancellation for the excess volume, safely starting from the back of your queue.
Section 4. Preserving your queue priority. Now we get to the real secret weapon: how this exact mechanism prevents you from getting bumped to the back of the line.
Instead of dealing with some crazy, complex action space with hundreds of variables, this research reduces the math down to controlling just 2 incredibly intuitive parameters. The mode, represented by omega, shifts the peak of your volume, moving the bulk of your orders closer to or further from the mid-price. Think of the mode like shifting the peak of a sand pile. Then you have concentration, represented by kappa, which acts kind of like gravity. It determines how tightly packed or widely spread that sand pile actually is.
And here is why this matters. Let's say the market moves and you shift your mode from 0.4 to 0.6. In a traditional setup, you'd have to cancel everything and start over. But with a scaled beta policy, there's a massive overlapping region. That overlap represents order volume that remains completely untouched during the shift. You're just gently reshaping a curve, meaning a huge portion of your existing limit orders stay exactly where they are. Boom! Queue priority saved, and your chances of getting filled remain perfectly intact.
Section 5. Smart inventory management strategies. Okay, we know how to place the orders safely now, but how do we automate our risk management to keep our absolute inventory close to zero?
Traditionally, if a trading bot acquires way too much inventory, it kind of panics and fires off market orders to clear it out. We all know relying on market orders crosses the spread, effectively guaranteeing a loss on those trades. But an inventory-driven limit order policy solves this dynamically, without that nasty extra cost. By using limit orders structured via our scaled beta policy, we naturally trigger mean reversion.
It works by programming specific parameter formulas that dynamically link your mode and concentration directly to your agent's current inventory levels. So, if your inventory gets uncomfortably long, you have way too much of the asset. The formula automatically pulls the mode of your bid orders far away from the mid price, while aggressively pushing the mode of your ask orders right up to the front. You're basically telling your bot, hey, stop buying and start selling aggressively. But only ever use passive limit orders. You're protected from spread costs while the bot automatically fixes its own imbalance.
When you map this out over time, it's beautiful. The agent's mid-price offset will literally mirror its inventory trajectory. As inventory drops into the negative, the offset spikes positive, completely in sync. This continuous automated skewing enforces that mean reversion perfectly. It successfully drags the inventory back toward zero without ever paying the premium of crossing the spread.
Section 6. The bottom line. The elegant math theory is great, but let's talk real risk-reward in a high-fidelity limit order book simulation. The data absolutely validates the playbook. When researchers tested this on the JP Morgan ticker using real historical data over hundreds of one-hour episodes, the tuned policy crushed it. It achieved a mean return of 0.52 and stayed profitable a massive 78% of the time. Now, sure, it still faces risks during highly volatile, trending periods, what market maker doesn't, but this approach demonstrated an incredibly strong risk-reward profile. It proves that mathematical flexibility directly translates to a tangible financial edge. This is just a massive evolutionary step for algorithmic market making. By swapping out those rigid block orders for beautifully flexible scaled beta distributions, you get to manage your inventory and keep your spot in line. Which leaves us with one really exciting question for the future of finance. With AI and advanced math now seamlessly bridging the gap between continuous logic and discrete order books, what traditional trading strategy is going to be redefined next? Thanks for hanging out with me for this explainer. Keep building, and I'll see you next time.